Hello and welcome to Jazz After Dark, everybody. How you doing tonight? It is late in the night, I'll be honest with you. I'm starting to think like I don't really care much for the closing beat. I wonder if it sends the wrong message. I'm thinking about doing more of these videos. What do you think? Tonight, be joining you with George Dickel. George Dickel. Actually, I have not had this since my 30th birthday, actually. We had a George Dickel 30 at my 30th birthday, and I thought I was hot stuff, man. I really did. What I didn't know, now that I am 40 something. Hey, anyways, we're going to talk tonight. How do you improve your returns using strategies that hedge funds use? And I get it. Hedge funds use an incredible amount of strategies, and every hedge fund's a little bit different. But what can you do in its most simple form to improve your total returns by doing something that doesn't take any additional risk, right? So you think like hedge funds, oh, they're swinging for the fences, they're doing all this crazy stuff. What can you do not taking any additional risk, and I mean that, to add to your total returns? This is something that we're working on here at Jazz Wealth to add. I am really excited about it. First of all, let's talk about this. So we did a study, and this has kind of been ongoing. I've done this in our wine and wealth classes with clients. I've done this with all sorts of different other classes. But we said, hey, what happens if we just compare the S&P with a portfolio where we take a small portion of it and occasionally sell covered calls? And what we're doing here is we're actually selling calls 10% out of the money. I use OTM, and I'm going to continue to use it with all the other data that I share with you so that it's simple, right? And so it's called a buy right. If you're old like me, you call it a buy right. If you're younger, you call it a covered call. So here in light blue is the S&P, $100 growth since 1996. We could go back further. This is just to give you a generation's worth of investing, right? So the concept of you were not investing in 1929 when the S&P first had its full first year. So let's give you a generation. I'm not cherry picking the dates. We can go back as far as you'd like. Actually, we can only go back a little bit further because of the advent of options, really. So we're really close, actually. So here's the S&P in light blue, the growth of $100. We start with $100. And at this point, as of what would be yesterday, really, 2 days ago, we end up with $1,075. Okay. Now, we say that along the way, we're going to take a portion of your portfolio and we're going to sell 10% out of the money calls. And all that means is that if the stock price is $100, we're going to go to the $110 call and we're going to sell it. We're not going to think about it. We don't care if it's going higher. We're just going to do it, right? And what we're trying to do here is see if we can add a few extra dollars. Now, there's no way for me to actually go back and say, in 1998, I want to use IBM. And I want to use some of the up-and-coming tech stocks that were coming along. They're all the dot-com stocks. There was no way for me to do that. So we go back and we say, hey, let's take essentially 25% of your portfolio and let's sell calls against it. And by doing that, we end up with a return off of $100 of about $15.41. This is no secret. I am not trying to convince you. I do not care if you believe me. But if you sell covered calls against your portfolio, you will, in fact, over time outperform the stock market. And that's just because of the generation of extra income. Now, what we want to do now is see how that applies to today. If I've made you want to think about doing this, would you like to advance your portfolio by using some of these strategies? And maybe you learn, maybe you go find other videos and you teach yourself, right? Well, in real time, we need to track the possibility of selling covered calls, or when you get fancy, covered puts. The same thing on the downside. I'm not saying that most people would do that. I just want to share the data. So what we've got to do is actually track the implied volatility of a stock relative to its actual volatility. And what we want to see is a spread. So over time, what happens, especially now during earnings season, is we have the implied volatility increasing, but the actual volatility decreasing. That spread is what creates premium. And I'm going to share with you a few examples in a second. So let's do it, actually. That should be good enough. We'll make it look fancy. I'll bring this down. Nope, that's as good as it gets. All right, so if we look right now as we head into earnings season, what we have in dark blue is the concept of selling a short put against a short position. That doesn't apply to a lot of people, so we're going to use the light blue here. selling a 1 month 10% out of the money call while owning the stock position. Realize that if you sell an out of the money call with the stock as a backup position, I'm assuming 1-for-1, then you end up with no additional risk. You end up with potentially having to give up the stock if it happens to have a great upside there, but you have zero extra risk by selling calls. Well, right now, what we see is that selling covered calls is getting a little bit more exciting. It tends to do this around earnings season and also towards the top of markets. The options market is actually a great place to look if you want to see what people believe about the stock market's location, and you don't want to use some random guy on YouTube. You want to use actual data, right? So here's what we have. Selling puts is becoming less popular, and that's because the market is extended. Options traders know it's really extended here, and they don't want any risk to the downside, even if it means giving up some of their short positions. Well, we have covered calls here, essentially covered calls, gaining a little bit in traction. What I'm showing you is the outperformance relative to the stock market based on what you do. In the long run, you will always find more outperformance by selling covered puts, or if you choose to do it, selling naked puts. And that's because even though there's a floor on the market, right, it can't go below zero unless it's crude oil just a couple years ago. It can't go below zero. And so the fear is the downside. No one ever fears the upside. Fear is what generates premium, which allows you to make more money and hence outperform the stock market. You still with me? George Dickel, he's got me thinking, smart for a night. Huh? All right. So what we find is the implied, in the S&P, the average implied volatility is up 2 points going into earnings season, which ranks in the 92nd percentile, happens to be my favorite number, in the last 1 month. While the actual volatility is down about 2 points. We have that spread that we're looking for, right? It's not crazy, but tends to happen around earnings season. And so the opportunity to sell calls still allows for a little outperformance. If you want to be so brazen or more aggressive and sell covered puts or naked puts, your outperformance would be greater. The larger the bar, the greater the outperformance, and this is in basis points. So 20 basis points is 0.2%, 40 basis points is 0.4%, et cetera, et cetera. You have a slight outperformance there. Catch my drift so far? In other words, if you're looking to sell covered calls, how do you do it? Well, first, we can't have one ETF or mutual fund in our account. You could sell covered calls in a brokerage account, an IRA, a Roth IRA, a SEP IRA, a simple IRA, and that's pretty much it. Joint account, trust account, things like that. The key here is, if you're selling covered calls, we first have to have a portfolio that's diverse enough to allow us to do this. We cannot have a portfolio that is the traditional passive investor portfolio of just like the SPY, the VOO, some sort of mutual fund that you may like. If you believe that you should be a passive investor and buy one of these index funds, I'm not talking to you tonight. I'm talking to somebody who says, I'd like a little bit more outperformance and I'm willing to learn and do a little bit more about it. Now, what do we do? So let's give you some specific examples. I'm not telling you to do these on these individual stocks. I just ran a scan and I found currently the ones that you might want to look at. So we have a portfolio. Let's just, for fun, I'm going to make it easy. We're going to say we have 100 stocks. At no point would most of you have a round number of shares in all of those stocks to sell one contract per call or per position. So what we usually say is take about 25% of that, find your large rounded sort of over 100 share positions, and go in there and find the point where there's a greater yield for selling a covered call. Not all of them will apply. Let's give you some examples right now so you can go out on your own and take a look at some of these. So what I did is I took a portfolio. Now, to be honest, I didn't build a portfolio. I actually just looked up these stocks to see. If you sell 5% out of the money calls on this group of positions, I'm not saying you would own all of them. I'm saying these would be a part of your portfolio. If you did it equally, you would end up with an additional 1.8% return for selling covered calls. Again, zero risk, right? The trade-off is maybe Carvana goes up 40% on earnings and you miss out on the 40%. That's the trade-off. If you go 10% out of the money, you collect 1.9%. So you make the decision whether you'd want to go 5 or 10% out of the money. The stats that we gave you in the beginning were based on 10% out of the money. Then what I did is I went over through and I said, okay, at the end of April expiration and May expiration, which stocks have the highest yield? You may not own all these stocks. You may not have even heard of any of these stocks, but let's use Carvana for example. Right now, Carvana has the highest total yield for out of all the stocks here to, how do I say it? The highest total yield for selling a covered call relative to the April expiration. So you end up with an additional 3.2% for selling, in this case, a 10% out of the money call based on where Carvana is trading right now. You may watch this video a month from now and go, I don't know what he's talking about. It's a lesson, right? So I put together a list showing that we don't want to sell calls on everything. What if we happen to own, I'm going to say Carnival Cruise Lines. Do you see Carnival Cruise Lines here? No, I would not sell a call on that. It doesn't fit into it. We may own it and want to keep it, believe in it, whatever happens. Norwegian Cruise Lines building their extra ships there. It's all exciting. We may look through here and we may say, I don't see Micron Technologies up here. I like MU. That's my ticker symbol. Well, you wouldn't sell a covered call right now because out of this group here are 20 stocks in your potential portfolio that give you the highest total return. If we look out to May expiration here, the yield gets a little bit higher. And I'll be honest, there's a lot of earnings in here. Now you start to see Carnival Cruise Lines. You start to see some of the other names like DocuSign, which will have reported by then, NVIDIA and Micron, which will certainly have reported by then. Nonetheless, you are someone who owns the position. You do not care if it goes down, right? You were going to own it anyways. You are willing to sell it if it goes up. If you do not care how far it goes up, you can add that additional return by selling those covered calls. This is a bit of a geeky lesson. I get it. Some of you are going to have problems with what I have to say. I'm just pointing out the data to show you that this is 100% possible. One last thing, if you're still with me, I do want to cover this since I know this was a bit of a detailed thing. Should you be looking to sell out of the money calls? Should you sell your covered calls based on a delta, very popular out there? Should you sell your covered calls based on a total yield? In other words, I will not sell a covered call unless I can get a 1% yield, a 2% yield, whatever it may be. Or by chance, should you sell covered calls based on free cash flow? Whoa, that's different. Let's take a look. All right, so we got a bunch of stuff going on over here. I'm going to slide out of the way ever so slightly. And what I want to show you is the total return based on how you choose to sell your covered calls. Now, I'm not going to stick around for all of this, so maybe you take a screenshot and study this one on your own. But what we have is the S&P's total return with dividends. Remember, total return includes dividends and dividends being reinvested the day after they've been paid. We've got 9.2% total return, we should say. So when someone says the stock market only gains 7% a year, well, they're usually including inflation. And so when they say 7%, they're actually not that far off. All right. Now we're going to have a series of strategies. We're going to say based on out of the money, based on deltas, because I know that's popular, based on the total percentage premium collected, which I showed you on the other screen there, and based on free cash flow. Well, it doesn't take a rocket scientist to look through here and say 9.2% annualized returns if I buy the S&P. All I want to do is know if I can do better. If I can do better, then I want to participate in that. Well, you know you'd have to go 10% out of the money, and that makes sense because I just showed you the performance of that going back to 1996. If you go 15% out of the money, this is a little misleading. When I saw that, I actually dug a little bit further. It's closer to the 11% mark. That may be good enough for you to do it. I don't know. I'm just saying there's a series of events, COVID and the dot-com era that we went through, especially the financial crisis that we went through, that sort of jar this number a little bit. So I would say if you had to scratch off any of them, not saying these things can't happen in the future, but I am a little skeptical about that. If you have, based on the delta, a lot of people like to look at that. There's a lot of great companies that teach you based on selling 30 and 40 deltas out of the money. Unfortunately, that does not beat the S&P's returns over the long run, and you can go through all of this and see the difference. If you look for your total yield, now this could be somebody who doesn't want to outperform the market. You are someone who says, I would like to sell with a 2% total yield, but I want less volatility than the stock market. It's not much, but it is there. So don't think that this is all for people who want to outperform the market. However, if you said, I would like to outperform the stock market with generally less volatility on a year-to-year basis, I might look at free cash flow. This is something we've spent a long time focusing on. I believe it's JP. One of the big names, I believe, was the ones that initially came up with this. I wish I could think of their name because I should do those things, share that. But it's not my information. Actually, selling covered calls based on a level of free cash flow generates a higher return than actually just investing in the stock market. Now, again, those are lots of numbers. I couldn't possibly create all those numbers from scratch just to try to prove a point to you guys. I hope it's a lesson that you decide, maybe I'll look into that a little bit, especially if you're younger. If you are older and say, I'm interested in covered calls, your concept is, I want less volatility than the stock market with a similar or better return than I can get in something more conservative. These are the type of things that we focus on here at Jazz Wealth. I don't know why I'm talking like this here tonight, but it sounds good, doesn't it? I think it's got a nice flow to it. So I hope you enjoyed that. Please let us know if you have any other questions. And if you'd like to work with us here at Jazz Wealth, we'd love to have you. Give us a call. Schedule a call on a website. Happy to talk to you and enjoy.